Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, to discuss if hopes for a new stimulus bill are fading or if targeted funds for the worst hit industries could be deployed. And Phil, while the market continues to recover, the Fed seems to think that we could have more of an increase of unemployment and layoffs.
Yeah, I think in general, the Fed's comments seem to be quite worried about the employment situation. And if you look at the recent commentary that they released this week, in terms of their worries about market volatility, it really hadn't increased. They discussed inflation, but it didn't sound like they were worried about it starting to happen. But they definitely mentioned the employment situation and unemployment a lot more than normal. And that does make sense when you start to look at the employment numbers. So today we saw, really the employment numbers are kind of stalled. And if you look at the Glassdoor data, it looks like potentially job openings are starting to topple over and actually reduce. And with the rescue plans potentially stalled until after the election, with more people being furloughed, and with the headwinds that we've got just from new coronavirus cases, it's possible that unemployment gets worse in October, not better.
Yeah, and part of that has to do, Phil, we're starting to see bankruptcies certainly increase among the sectors that we've been concerned about, services, energy, and so forth.
Yeah, and I guess in a way this kind of speaks as well to the K-shaped recovery, but it also speaks to the fact that the Fed also said that they were seeing the data relatively better than expected or less bad than expected. And I know at conferences lately I've been getting questions about credit exposure in the real estate and financial sector, and you can see from this chart, they're both at the very bottom of the chart. They haven't had that much in the way of bankruptcies. So credit exposures and defaults from people, not renting offices or moving out of apartment buildings or not going back into commercial spaces doesn't seem to have affected the REIT space yet, or even mortgage debt that financials are holding yet.
Yeah, no, it's also interesting too. You have this chart with the change in visits to workplaces. It's interesting to see the low reading for real estate, given that even though folks are allowed to go back into the offices, it's just conditioned where people are not comfortable going in, whether they have kids at home or whether they just don't want to have to deal with the commute, or they don't know what the commute looks like, or they don't want to wear a mask all day in the office. So it's interesting to see that real estate hasn't really caught up with it yet.
Yeah, and I guess in theory, if we have a vaccine and we're all safe to do things like normal again, as we've said a bunch of times, in 6 or 12 months, we might all be quite happy to go back to work and say hi to each other in person again. And so we do need the office space. I know there's a lot of talk about whether we'll need the same kinds of office space or the same levels of office space if people want to work from home a little bit more than normal. And we've certainly shown in the services sector that you can do that pretty productively if you're in an office job with the new tools like Zoom and some of the networking tools. But you're right, like Manhattan, some of the bigger cities, people are definitely voting with their feet, so to speak, and not going back into the office just because they conceive that there's a risk doing that. But even US-wide, offices look like they're about 30% empty still, and they have been that way for the last few months. So there's really been no change, even though we're definitely learning how to deal with COVID better and the treatments are getting better. The people's willingness to go back to the office has been pretty much stuck.
And speaking of defaults, how about state tax revenue, how that has changed year over year from 2019?
Yeah, I thought this was an interesting chart because clearly the states have been spending a lot of money to try and have their health system up to speed for COVID and dealing with all of the crisis. But at the same time, if property values are down, if retail spending is down, they're probably earning less tax revenues. And so this shows the impact by state. And you can see the darker the red, the more the revenues have fallen this year so far compared to last year for their financial year. It's a pretty red story, isn't it? There's a few states that have had net increases in taxes, but this is why the second round of stimulus that's being discussed right now in DC is also very important for states because their budgets have big gaps in them as well.
All right, Phil, thanks for the update and for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.